On today's show, our expectation for 2025 and beyond, why trillion-dollar companies are trading like meme stocks, community sentiment, and where to find value in this overvalued market. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks moved ever so slightly higher on Monday as Bitcoin hit fresh all-time highs and investors geared up for the dated packed week and the FOMC this week. The Mag 7 stocks all outperformed except for Nvidia, which was down 1%. We probably are seeing some form of a rotation here from Nvidia to AVGO, which was up another 10%. The stock is up like 40% in the last 4 days. A trillion-dollar company, literally trading like a meme stock. Crazy. But that just goes with the AI theme and the earnings power of semis. We also saw Intel as well as MU Micron up 6% again, going to the AVGO theme, as well as Micron reporting later this week. And all of the other big names gained. Microsoft, Apple, Amazon was up 2%, Tesla up 5.64%, I think the best performing of the Mag 7. Google was up 4.46%, Meta up 1.64%. And then the actual broader market really did fall. I mean, there were some winners, some losers. We saw credit services here was fairly upbeat. Banks as a whole were kind of mixed. But then healthcare continues to decline, which is absolutely crazy, getting really oversold in my opinion. We saw energy stocks down very, very big, and the broader market continued the trend of what we saw last week, and that's outperformance by the mega caps, underperformance by the broad market. However, when you actually break things down into their factor and size segment, it was really just the value component of large and mid caps, as well as mid cap core, that really didn't perform well today. Everything else was actually pretty good. I mean, growth definitely was the winner. We saw large growth, mid growth, small growth all perform very, very well today, as well as large cap core up 0.85%. And then that was really it. Small cap core and value did gain ever so slightly, but inconsequential to the gains we saw here in the growth segment of the market, with large cap growth, the mega caps, the Magnificent Seven, taking the cake today up 1.39%. And that is the trade we really saw. The Magnificent Seven won, with the XLY, XLK, XLC all gaining 1.31 and 0.67%, with the SPY up 0.4%. The XLI was the only other sector in the green apart from these sectors right here, which contain the Magnificent Seven. It was up a mere 0.17%. Every other sector lost. Energy, a complete dumpster fire today, along with healthcare, down 2.08 and 0.95% respectively. And really, guys, it was cyclical growth the market piling into today. And again, what we are seeing is just a rotation, from the broader market into the mega caps. And as a result of that, market breadth continues to look, I wouldn't say great, but I wouldn't say bad either. We are seeing stocks lose their 5-day and 20-day, still below the 50% mark. However, we did actually capture some momentum. Look at last Friday versus what we actually saw here today. However, medium-term and longer-term trends continue to remain intact. And that's just telling us that you should probably look to the broader parts of the market, buy those dips, and that should produce alpha into 2025. Now, where we saw some of the biggest losses today was actually in the healthcare sector. Healthcare stocks continued their slide. UnitedHealth down 3.53% again today, down 20% in the last month since Trump's election, since the assassination attempt of its CEO. And also Trump came out today saying that he's going to quote unquote knock out the middleman when it comes to prescription drugs, essentially making prescription drugs cheaper. That literally hits both the top line and the bottom line of these healthcare companies, and the market going ahead and just re-rating healthcare as a whole, especially with the Trump situation, the RFK, and all of the angst with healthcare right now. However, AVGO up 10%. That was on the back of its earnings. The hype continues, and we're probably going to see 250 and above for this name into the end of the year, maybe even 260. But yeah, dude, $1 trillion company trading like a meme stock. It's absolutely wild. And then looking at volatility, we saw Bitcoin hit an all-time high today at the 106 area. It actually briefly did touch the 107 area, But this is on the back of MicroStrategy buying more Bitcoin, as well as overall just a risk on sentiment that comes in the month of December. In fact, December is seasonally very bullish for Bitcoin and risk as a whole. And what also really did help stocks move higher today, because all in all, the Nasdaq 100, the Russell 2000 and the S&P 500 were positive today, actually had to do with some economic data. Now, we got the US economic output figures, essentially PMIs, the composite manufacturing and services PMI. Now, if we look at the composite PMI, 56.6, this is one of the highest numbers we've actually seen in 3 years. Look at the composite output, absolutely crazy, just soaring. However, it wasn't all good news, because if you actually look at the manufacturing output, or essentially goods manufacturing, right, it came in at 48.3. It actually missed the consensus expectation, and goods manufacturing continues to be in this like a decline. So we saw services smash expectations, 58.5 versus 55. Then we saw goods manufacturing miss 48.3. Below 50 is a decline. And then when you put the two together, you get the composite PMI, 56.6, and one of the highest figures we've seen in 3 years. So US economic output is on a tear led by services, and this is actually one of the biggest reasons why we're actually seeing the US economy do really, really well. And looking at the charts, if we actually look at the indices, very, very strong day. The S&P 500 up 0.43%, the Nasdaq 100 up 1.58%, the Russell 2000 up 0.53%. However, when you look deeper, you dive under the hood, things not looking that great. The RSP down 0.33%, mid caps down 0.09%. So there still is that churn going on under the hood. I mean, the place to be right now is the mega caps. You know, the Nasdaq 100 doing really, really well. That's a very solid day. And that's on the back of Nvidia actually falling 1%. So it really goes to show the strength we're seeing in all of the other mega caps. All in all, though, we actually did see constructive price action in the other parts of the market. The 2-year, 10-year yield fell. The 30-year yield gained ever so slightly. The dollar fell as well. Bonds gained, and then metals were mixed. Gold gained, silver lost, crude was down 1%, Bitcoin up, as you can see, 1.69%. All in all, it was a very mixed day across the board, but the place to be was certainly in equities. And looking at the S&P 500, guys, we continue to see breadth remains not that constructive, as the S&P 500 has somewhat traded like higher in the last couple of weeks, right? We've actually seen market breadth sort of trade sideways. That is a bit of a divergence. In other words, a small handful of stocks, the Magnificent Seven, really leading the charge. That is what this is telling us. Nonetheless, the S&P 500 continues to be in positive gamma. We continue to see sideways momentum here for most of the month of December, apart from the early parts of the month. And we're trading somewhat at the highs here of the core resistance, meaning that we do have a little bit of upside momentum, but mostly asymmetrical downside to the gamma flip. Now, is that going to happen? I don't really know, because pretty much from tomorrow is when the last 2 weeks of December officially start. And from tomorrow, the last 10 trading days of the year take place. And they are very, very bullish. However, we are in positive gamma, and you do want to buy dips, sell rips to that core resistance area. Looking at the Nasdaq 100, guys, absolutely smashing. This is just some crazy momentum we're seeing near the mega caps, really leading the charge. We're pretty much at the core resistance. So unless this actually moves up tomorrow, we probably do target some downside to the gamma flip zone as a dip buying opportunity before we actually go higher in the Nasdaq 100. Very, very crazy price action. Look at this year-to-date chart. Absolutely insane. And we're seeing very similar capitulation right here, like we saw right here. So maybe this could signal the end of the move. You generally get these like massive, massive candles, this capitulation at the top, and then we sort of get a pretty massive move to the downside. Now, I'm not going to say we're going to fall out of the sky, but I'm just saying things look eerily similar, all things considered. Nonetheless, the momentum is on the side of the mega caps, and you don't really want to fight that trend. And any dips we do get, you want to buy that dip, particularly to get to the gamma flip zone, right? That's a great dip buying opportunity for us to go higher. And we do know that there's very positive momentum in the economy, the fundamentals, earnings, the US market, the consumer. Everything looks really good for equities just to go higher. So you don't really want to fight this trend. You really just want to get on board the trend, and any volatility rally and dips we do see in this market, you want to buy those dips. And right now, it does look like a dip is more inevitable for the Nasdaq 100 first more than anything. However, if the core resistance moves up, then that signals more upside. That is the plan we follow on this channel. Now, looking at the RTY, the Russell 2000, the IWM, it is finding support here at the put support. That's very interesting. So we slid right through the gamma flips on the yellow line right here. And now we actually should look for support and then a move up to the gamma flip, break the gamma flip, and then a move higher to these 52-week highs. Okay, the bulls really need to put in work right here, because if we get another red candle like this one right here, and then we slip like right below this level, right? If we do that and we actually go ahead and break that level, this level right here, it's not a good look. That would be a lower low. So what we really want to do is hold this level right here in the Russell 2000. Bulls, do your thing, hold this level. That would mean we're forming a higher low after a little bit of pullback. And if we go ahead and break the gamma flip and then continue the move to the upside, that would be very, very constructive. But it all starts here at the daily level. And that means we actually need to buy dips right here. Bulls need to do their thing and take us higher above the gamma flip. So it's now or never for the bulls, because if we start moving below this put support, the put support starts moving lower, the gamma flip starts moving lower, the core resistance starts moving lower, and we start making lower lows relative to these lows right here below the 2280 level, it's not going to be a good thing for the Russell 2000. So bulls need to hold this level, otherwise it can get a little sour for small caps, but things looking constructive right now, all things considered. Looking at gold, I think gold's going to continue to do what we've seen in the last couple of months, and that's sort of trade in this like very wide range. We're going to trade sideways, digest the 30% plus gains we've seen this year in gold, and then make the next move higher. I think Bitcoin, that's another all-time high, and I think it's going to continue to do that. I think we're going to continue to see new all-time highs in gold, and we're going to see a bit of a pullback and then a move higher, a bit of a pullback and a move higher. You know, that is the thing. Bitcoin is very volatile, one of the most volatile assets out there. So if you're going to buy into this asset, you need to contend with the volatility, get ready to buy dips, and also just hold. It's a volatile asset. It is what it is. But all in all, guys, I think equities still look very constructive. I know the RSP has had 11 down days in a row. Just look at that. That almost looks comical if you ask me, but I think equities look really good. I think this is a dip buying opportunity for the RSP, as well as all of these stocks. I think we're going to move higher into next year, but we want to have exposure to the mega caps. We also want to have exposure to some of these smaller names, right? I'm talking about names like PayPal. You definitely want exposure to names like PayPal, okay? Very, very strong trend. You want exposure to names like Paycom. In fact, we've seen a little bit of a pullback here in Paycom in the last couple of days, as you can see. So I think we are getting ready to actually move higher for Paycom. Great opportunity right there. You can see down 1.16% here today. So, however, it's forming a higher low relative to this low right here, and we should see the next move higher for Paycom software. Guys, Google, this stock was left for dead suddenly in the last 5 trading sessions, up 25%. Absolutely crazy. And the DOJ risk, antitrust risk just disappeared. ChatGPT risk just disappeared. All of these risk factors disappeared because of quantum computing. That's an all-time high for Google and a great name. It's still fairly cheap if you ask me. So if you're looking for a mega cap name, I'd look at Alphabet, I'd look at Amazon as well. I'd look at PayPal and look at Paycom. If you're looking for those of you that trade on the ASX, I really still like Pexa Group. I think we're probably at the lows. I started buying around here. That's where I actually started buying the stock. We actually have traded a little bit lower, but I do think this is a great name, backed by fundamentals, international expansion. This is a name I want to be in for 2025. It's actually a software real estate play. I think software is going to do really, really well. And I do think residential fixed investment, the housing market, is going to open up with rate cuts, and we're going to really see that part of the market shine. And this is just some short-term weakness we're seeing just based on a location we're seeing in the market right now. So the place you want to be in 2024 is software and real estate plays, rate cut plays. And I think this is one of them. It's going to do very, very well. Another stock I've been doing a lot of due diligence on, guys, is Uber Technologies. I still don't know what to think about this stock. Uber is up 0.55%. We're doing a lot of research onto autonomous vehicles, but the research is kind of vague, but I do like the valuation. I think it's actually very cheap right here. And I think this is probably the place where you actually want to buy. There's somewhat of a trend line going on, something like that you could buy if you're a technician. But the fundamental support, this stock now trades on 18 times forward earnings. Absolutely cheap. Cheaper than the S&P 500, actually cheaper than PayPal on a forward-looking basis. So great valuation, I think, right here. Immensely free cash flow generative, growing at about a 20% clip at the moment. So great opportunity here. I think the market has got this wrong. However, it's really arrogant to say that. Nonetheless, if I do take a position in Uber, I will let you guys know. I haven't yet. I still don't know how to discount autonomous vehicles and autonomy. Nonetheless, I think this is good value here, but I don't have a position. Guys, but all in all, buy the dips in those individual names, or just look at something like the Nasdaq 100. Don't overcomplicate it, or the S&P 500. Sometimes you just want to buy something like this and just hold dollar cost average. Either way, I do think we continue to move higher into the end of the year. That's exactly what I've said we're going to do, and that's exactly what we're doing. I said we're going to move higher in the second week, and we have the S&P 500's up, the Nasdaq 100's up, the IWM is higher than it was today. That was my prediction for the month of December, especially these last 2 weeks, and we are starting to see that momentum trade build. So guys, buy the dip if we do get any dips, and just hold on to the gains, because we're going to squeeze out the last bit of 2024's gains before we continue into 2025 and beyond. And let's talk about sentiment. This is the weekly sentiment poll we do on this channel every single week. If you want to be a part of these, go ahead and subscribe. We do them every single Saturday. You'll see them on your YouTube feed. Now, this week I asked, how are you feeling about the Russell 2000? And 58% of you said you were bullish. Now, this is actually a decline from last week's 70% number. Nonetheless, still very bullish sentiment and a lack of bears. And those that are uncertain, not that many. So either you guys are very certain of a bullish trend or a bearish trend, not many in the neutral camp. And historically, the Russell 2000 tends to perform well in the final months of the year, thanks to a mix of strong seasonals as well as holiday-driven optimism. Bullish sentiment during this period can amplify buying activities as investors anticipate higher prices that pushes up demand. And this kind of creates a feedback loop where more buyers drive prices higher, which just attracts more buyers, and then you go from there. And that's sort of what we see in December. However, the key in times like these is to stay grounded and follow your trade plans, assess the fundamentals as well as broad market conditions. And while we as retail traders are bullish, so too is Wall Street. In fact, the average analyst forecast for the S&P 500 leading into 2025 is 6,700. The most bullish price target is Oppenheimer with 7,100. The most bearish, which is still bullish, is 6,400. I should really say the least bullish is 6,400. The top end of the range represents about a 17% upside from where we closed. The bottom end is about 7%. The average price target about 10% from where we are right now. And if we actually have a look at everything, these price targets are very, very clustered together. From 64 to 7,100, very close. Last time we saw a consensus band that close was 2017 as well as 2008. In 2017, we had a 2,300 bottom consensus target, 2,500 the top, very tight band. What did the S&P 500 do in that time period? Closed at 2,700, smashed the most bullish price target. We saw a very similar situation in 2008. Anywhere from 14 to 1,700 was the consensus band of price targets. What happened in 2008? We absolutely smashed the most bullish price target, closing at the 900 mark, and that was actually below the most bearish consensus estimate. Other words, if history is anything to go by, a tight consensus band of analysts means we are either going to smash to the upside or downside. So do expect volatility this year. And Fundstrat Tom Lee actually see that type of volatility. They expect a very bullish first half into 2025 and then very muted returns into the end of the year. And this is simply based on history. Going back, looking at the times when we've had two back-to-back 20% years in the S&P 500, what we normally saw was that the following year tends to have a strong first half and then a very weak second half. And that's why Tom Lee see the first half S&P 500 price target of 7,000, but they have a year-end price target of 6,600. Very contrarian if you look at it in terms of what they're doing, but still within the consensus if you actually look at the top price targets as well as the average. So all in all, Tom Lee see a 10% gain throughout the year, but not without some volatility. However, if you are looking to extract alpha throughout the entire year, you may want to look at small caps. Small caps relative to large caps is actually at the 17th percentile. Historically, when small caps is this cheap relative to large caps, the forward returns for small caps saw outperformance or alpha generation in excess of the S&P 500 of 5.4%. Guys, just to put that into perspective, when you beat the S&P 500 by 1%, that's huge. That's massive alpha. A 5.4% return historically based on relative performance, those are odds you want to take because that is extreme alpha generation. So the place to be is the broad market small caps, Russell 2000, but I would pivot more to profitable small caps, maybe the S&P 600, as well as something like the XSHQ, the small cap quality ETF. But small caps will only outperform if the macro holds in there, and that is yet to be seen. And the truth of the matter is the macro is very robust. Now, inflation has come down. We've seen quite a lot of disinflation, and we have seen the move to 2% sort of stagnate here. We moved up to 2.7 from 2.6% in the CPI index last week. This is the US inflation rate. However, that was the consensus expectation. And what we do want to see now is inflation continue to move lower to the Fed's 2% target. Now, if inflation is to reaccelerate, that can be bad unless it's accompanied by strong growth. That's exactly what we're seeing right now. The Fed's GDP now, fourth quarter tracking estimate, sitting at 3.2%. And with this strong growth, we're also seeing a very robust consumer. Services spending and retail transaction growth is up 3% compared to 2023. That's exactly what you want to see. So we have strong, robust economic growth and a healthy consumer. That's exactly what you want to see. Now, we do get more inflation data this week. PCE is on the decks at the end of the week. Now, the median forecast headline is 2.5%. Now, that will be an increase from the previous month of 2.3%. So the market is expecting a headline increase. However, core is expected to stay the same. Now, the Fed's preferred gauge of inflation is PCE, and they pay a lot of attention to this core figure. So you really want to look at this 2.8% figure. It's the year over year, as well as the 0.13%. That's the month over month figure. If we get these figures in line or cooler than expected, markets will rally. If the headline and core figures come in cool, even better, but we do not want to see a hot number at all. Core services, excluding housing, we're looking at a 3.5% growth there. However, guys, everything you want to pay attention to is this core figure right here. 2.8% year over year, 0.13% month over month. That's actually going to be rounded down to 0.1%. That's what they do when they give it out to the media. So we want to look for 0.1 core, 2.8% year over year. We get that, Bob's your uncle, and it's off to the races. Along with PCE, we get a number of data points, but tomorrow we want to look at retail sales. Month over month, the consensus there is 0.5, and then industrial production, the consensus is 0.1. That's really it up until Wednesday when we get the Fed press conference and the FOMC rate decision. 96% chance in the market we're going to get a rate cut of 25 basis points, and then we also get building permits and housing starts on that day. The consensus expectations there is for 1.34 million and 1.473 million, guys. And then we'll tackle the big data points on Thursday in the rest of the week. Now, for earnings, we don't have much tomorrow here on Tuesday, but it does kick off on Wednesday. We have General Mills and Birkenstock before the open, Micron and Lennar after the close on Wednesday, Accenture before the open on Thursday, Nike and FedEx after the close on Thursday, and then Carnival Corp and Winnebago. A lot of consumer stocks here on Friday. So we have big companies reporting throughout the week except here on Monday and Tuesday. But the lack of earnings on those days is more than made up for in the data prints we got today and we'll get tomorrow. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.